Quick introduction on my side. My name is Michael. I run the compliance department at Paystack. Paystack is one of the leading fintech companies in Nigeria, based in Lagos. I have been joining this company roughly 6 months ago and helping them boosting their compliance program. I'm in compliance probably around for, I want to say 12 years now, and in the fintech space for roughly 5 to 6 years. My previous stations have been Flywire, fintech unicorn based in Boston, and before that running the AML program for Western Union Digital in Europe. I'm going to talk about financial crime compliance today. The reason is it's one of the key focus areas of regulators throughout the world, where they expect all sort of financial institutions to comply with. It's quite important. Non-compliance has severe consequences for the success of the company. And I'm going to talk you through what it means to become compliant, what is necessary, and it's going to be a crash course. And the crash course will cover only aspects on a superficial basis, and not going into details for national regulators. I understand the audience is coming from various countries throughout Africa, and this is going to be a starting point. Obviously, if you consider a career path in compliance, you will have to work out with the details with national guidelines and implementing orientations provided by the local authorities. I'm going to start my presentation. Hang on a second. I hope you can see it. Unfortunately, I can't see any comments right now. We're going to cover various aspects of financial crime compliance as displayed here on the agenda. I start with a few definitions. I walk through customer due diligence process, also known as KYC, ongoing due diligence, sanctions and embargoes, which is another key area. Then move on to transaction monitoring and screening, and then in the end, lose a couple of words around suspicious activity reporting and record keeping. What is money laundering? Money laundering is at least the attempt of disguising funds from illicit origin. Imagine that you're dealing with persons engaging in criminal activities such as drug trafficking or terrorist financing. They will try to use your financial institution to run through their funds. Money laundering is obviously a crime, but only part. It always requires a predicate offense, which is also a crime, and is up to the financial institutions to identify these predicate offenses, to report them to the respective authorities. Why is there money laundering? Mostly because of two reasons. First of all, a successful money launderer wants to hide the origins of the illicit background of the funds. And then secondly, illicit funds can be subject to seizure, and obviously that's against the interest of every money launderer. There are 3 stages. The first one is you are in possession of illicit funds directly stemming from an illegal activity. and you want to start placing them into the financial system to the point where it becomes non-traceable, and then you can start using that money to purchase whatever you want to have, and don't have to bother with any background research on that. The money laundering process goes through multiple phases of layering, where you just keep on moving around from account to account, very often including cross-border transactions. You build up a trail where it becomes nearly impossible to trace the origin of the funds. And in the end, you will elude the detection of these so-called origin funds. In the third stage, which is the integration, you have been successfully running through the layering process. You are in possession of funds which seems to be from legitimate source. And once you have that money at your disposal, you can then start purchasing whatever you want without fearing that this money becomes subject to any seizures or further investigations. The second key aspect is terrorist financing. Terrorist financing has been introduced as a matter of investigations for financial institutions starting with September 11. And the key difference between money laundering and terrorist financing is that terrorists don't really bother where the money is coming from. They have an intention to disguise what they want to do with that, which usually goes like in weapon purchases and other illicit activities they want to fund with this money. When introducing a compliance program for your financial institution, everything starts with the customer due diligence process. The customer due diligence process is also known as KYC, Know Your Customer. It is a process where you do proper investigation in your customer. You try to understand who he is, what he's doing with your business, why does he want to establish a business relationship with you, and who are involved parties, so that you have a complete picture, so that you understand the business relationship, which then helps you calibrating your money laundering controls in your institution. I'm going to start with the first bit. The first bit is around identification. That is a two-step process. The first step is ascertaining the identity, which means basically you ask the customer to provide a lot of information on themselves. And the second piece is verifying said identity, where you collect meaningful documentation which support the information provided by the customer. All this information and the documents collected in the process during KYC must be properly documented and stored in your financial institution. Usually that looks like the following here. We separate between natural persons and legal persons. The minimum information you have to collect is first name, the surname, the gender, and the date of birth. Obviously, and I've mentioned this before, depending on the jurisdictions you're operating in, you will have to collect maybe more information. But in general, like cross-border, that is usually the minimum you have to think of. For legal persons, the effort is a lot more. You have to go into the details of the company, the name, the legal form, where is it registered, who is the registering authority, the registration number, where is it incorporated, very important, what's the purpose of the business, and then, which is quite a cumbersome process, is establishing the identity of the management bodies, and even more difficult going into the beneficial ownership structure. For natural persons, people need to provide photo identification. That is an official document, valid document, provided by national authorities, usually an ID card, a passport, a voter ID, very much depending on the jurisdictions you're operating in. They will provide you with more details what can be acceptable. They all have in common that it is issued by a government authority. It has a photograph of the head of the person, which can't be replaced, and contains details on the person, which are the name, again, the date of birth, the signature, and the authority which has issued the document. The second part of the KYC process for natural persons is the proof of address. You have to collect proof of address for every single customer. Proof of address can be two main categories. The first one is a document which has been issued from a company which is subject to substantial AML regulations, like banks, insurances, and etc. So, for example, you can collect bank statements, credit card statements, and so on. Or, or you can collect documents from utility service providers which provide utilities straight into your house. Water, gas, electricity, landline phone, internet, cable TV, obviously not mobile phone because that is not a service delivered into your house. Or the proof of addresses must not be old, usually than 6 months on the day of the identification. When it comes to legal persons, you also have to run through a verification process, which looks a bit different. When you start incorporating a company, you're being asked to provide a lot of documents to the registration authorities, who will certify you and provide you with the respective proof. That can either be an extract of commercial register, depending if the respective jurisdiction maintains such as one, or a set of company documents, memorandum of association, company statutes, certificate of incorporation, and other documents. These documents provide usually information on the purpose of the business, the management structure, the beneficial ownership structure, and the place of the business. Once you've got done through that process, you have to have a look into the management body, which is the board of directors and the company officers. Usually you run through the very same process as for natural persons. You have to collect personal details and ID documents to make sure that these persons exist and are legally authorized to represent the company. One of the most critical parts when it comes to KYC, and it's the most burdensome, is identifying who is the beneficial owner of a legal entity. There are various ways to identify a beneficial owner. The most direct one is to have a look at the persons, the natural persons who have a sufficient participation in the company, or they have voting rights or any other means of direct influence on the company. And not only have you do this for the legal entity who is your customer, in case of multi-layer ownership, so where a company is owned by a company, is owned by another company, and so on, you have to go through the same process for every single layer and just make sure that you understand on each layer, that you understand ownership and ownership structures and beneficial owners for more than 25% of shares. Obviously, that can also differentiate depending on the jurisdictions you're operating in. There are certain cases where you're allowed to apply lesser standards, where you can run through the fast lane in a due diligence process. It's called simplified customer due diligence. And that is the case if you have 3 different types of customers. The first one is if the customer is a governmental authority or a public body, including their own subsidiaries. If you're operating with a publicly listed company, or you have a credit and financial institution as one of your customers, because they are under the same supervision as you are running a financial institution. In most cases, unfortunately, you end up with rather applying what we call enhanced customer due diligence. Enhanced customer due diligence is mandatory in 2 cases. The first case is depending on the individual financial crime compliance risk assessment each financial institution has to prepare. The local regulators usually accept the fact that every single financial institution is different, offers a different type of service, services a different structure of customers. So they usually leave it up to you to identify what is higher risk, what is lower risk, which needs to be properly elaborated in said risk assessment, and also provided to the regulators. They will review and say they agree with your approach here, and according to your approach, this is how you apply the various levels of due diligence. There are also certain occasions where you have to apply enhanced customer due diligence on a mandatory basis. That is, if you are operating on a non-face-to-face relationship, so you never get to see your customer for whatever reason, or you deal with politically exposed persons. I'm going to come to that in a second. Or in any other situation where by its nature the customer risk presents a higher risk of money laundering and therefore a higher risk of control and monitoring. What does it mean? In the financial crime risk assessment, you start thinking of 3 main categories. You start thinking of the customers you want to serve. You think of the products and the delivery channels, and you think of the geographical area you're operating in. All these 3 areas pose a different risk depending on what you're offering. For example, when you look at the customer risk section, what could be a potential higher risk of money laundering is if you are dealing with an unusual customer which doesn't necessarily fit your audience. You're operating in cash-intensive business, as it is the easiest way to disguise the origin of funds. You deal with legal entities who have an intransparent shareholder structure where, for example, you have bear shares, where the owner is the person physically holding the shares of the company and can easily pass on, so it's quite difficult to keep track on that. Or you're dealing with complex and unusual ownership structures. I'm going to demonstrate it later as well. In terms of product and service, what could be considered there as a higher risk is if you receive payments from parties usually you don't expect to receive from. You are offering products or transactions which by its nature provide an increased level of anonymity. You're operating in a non-face-to-face environment, or you started to launch a very new product where you have very limited experience with, and you just want to raise your level of comfort and just see how it's been accepted in the market, how people are using your product, and you can demonstrate that it is under control. And obviously when you deal with straw companies, and which you basically never should, but there's always the option that a legitimate customer is being owned by customers by other legal entities in the background, which are quite difficult to understand who is behind there. In terms of geographical risk, it very much depends on the respective jurisdictions. Every single country on this planet has money laundering regulations in place, but with a different level of effectiveness and scrutiny. And you have to understand the regional risk. You have to go through and see, are transactions from certain countries posing a higher risk to your financial institutions than others? For example, here in Nigeria, when I operate in Nigeria and I have my customers in Nigeria, I automatically face a slightly lower risk. If I, as a financial institution in Nigeria, deal with customers coming, I don't know, from North Korea, then there is a higher risk because they have barely any meaningful controls in place. There are certain other factors you have to weigh in. There are, for example, the level of corruption. There are certain third parties out there who provide meaningful documentation, that like Transparency International. You may come across countries who are subject to sanctions, and you also come across with countries who are very likely to support terrorist organizations. And this is where you have to be very careful and understand that the money you're dealing with, the transactions you have to come through, the customers you have to come through, will not be brought in any context to set circumstances. One of the mandatory cases of EDD, enhanced customer due diligence, is when you deal with politically exposed persons. A politically exposed person is any given natural person from a home state or a third country, which is or has been entrusted with a prominent public function. A public function usually means government function and other higher functions in the country. That can be also religious leaders, that can be the High Court of Justice. There are various instances where you have to understand that there are persons with certain powers, and these certain powers can easily be misused for entering a corrupt relationship with other people to get access to illicit funds and to use your financial institution to launder that type of money. Not only is that type of politically exposed person considered to be a PEP, it's also the family members, and it's also, if you become aware of that, close business associates. You have to understand for every single customer relationship, being it a natural person or being it a legal entity, whether there is a politically exposed person involved. In the KYC process, you establish all the natural persons who have a stake in that business relationship, and they all have to be positively or negatively matched against the PEP status. Another mandatory case of enhanced customer diligence is when you deal with complex ownership structures. What is a complex ownership structure is when it becomes really, really difficult to understand who are the ultimate beneficial owners exercising control over the company. The more complex, the higher the risk, the more investigations you have to do to investigate. That is usually also the part of the KYC process where you spend most of the time to clear a customer and allow the onboarding. Why do we need to understand this ownership structure? We want to understand the point of control where potentially illicit money can enter the financial system. The keyword obviously is control, not necessarily a shareholder who can be a straw person. So you really have to understand who are the key persons in the background. And then you have to run through the full identification verification process as demonstrated earlier in the verification process for natural persons. At this point, I want to make a short break and hand it over to Amanda for a couple of questions.
Okay, so the most popular question we have for you, Michael, is, are you going to share your slides with us?
Yes, I can do that.
Okay, perfect. So Michael's going to share the slides, and since we have everyone's email address, they'll be emailed to everyone, possibly sometime after the master classes. Okay, and then another question is, could you explain what new product of business practices means?
Sorry, say that again, please.
Could you explain what new products of business practices means?
Okay, so imagine you are an online payment service provider. So your key business is collecting funds from payers and settle with merchants. Now, once you run this quite successfully, you start thinking of diversifying your business, and you say, like, I want to enter into the money remittance business, where I send money from one country into another country, which is fairly new. Usually, you start building from scratch, and you want to you offer it newly to the customers, but the experience in-house is quite limited. So what you do in the beginning is you be very careful to see and understand how a customer using you, because criminals are really smart usually. They understand that when you launch a new product, that you may become a bit more vulnerable to illicit money transfers, and they want to start right from the beginning to funnel money through your institution. And only over time, once you have a better understanding, a better grip on your business, you will then be in a position to lower the risk, the overall perceived risk, and to lower the controls, because you know where the risks are, and then you can focus your resources on that particular area.
Okay. Okay, thank you so much, Michael. If anyone has any more questions, please feel free to pop them into the Q&A, and Michael will give us another short break where he will answer any questions. But you may go ahead, Michael.
All right, hang on a second. I'm going into presentation mode again.
Okay.
So we have now a situation where the customer has been successfully onboarded and has started transacting with your company, but that doesn't necessarily mean that any ongoing monitoring obligation has been waived. So there are a couple of things you have to consider in an ongoing business relationship. I'm sorry for that. So first of all, is you have an obligation. Every single regulator on this planet will ask you to have a very close eye on the customer. And it's not only the customer they ask you to have an eye on, but also on the transactional behavior. In the beginning, in the KYC process, you try to understand, or you try to estimate how the customer is going to use your financial institution, and you try to build a profile around him. And in the end, you're required to make an ongoing analysis of said customer if he stays within that built profile. When you are looking at the customer, a customer can change, and it's perfectly normal for customers to change. It's perfectly normal that there are changes in ownership structure. It's perfectly normal that there are changes in the director ownership. It's perfectly normal that they change the purpose of the business. However, you need to be aware of that, and you have to make sure that the documentation and the information you have on that customer is always up to date, and that is called the ongoing monitoring. There are mainly speaking, three different categories of customers: high risk, medium, and low risk. Also, depending on the jurisdictions you're operating in, they might require you to be more precise on that and have more categories, but I just try to keep it a bit narrow here. Usually it means when you deal with high risk customers, you're required to reach out to the customer at least on an annual basis and talk him through the information you have on him on record. Ask him, is this information still accurate? If there have been changes, you have to update this information and update the respective documents. If you're a medium risk customer, you have to do the same process around every 3 years. And when you deal with low risk customers, around every 5 years. In terms of transactional behavior, for high-risk customers, you have to be quite careful, and you have to very closely monitor the transactional behavior. And the lower you get on the risk score, the more leeway you can give to the customer, because you have already built up a certain level of confidence that they are not going to misuse you for money laundering. The KYC refresh, which is going back to the customer and ask him about the changes, is usually a spot check on the management structure, on the beneficial ownership, the business purpose, and the transactional profile. And then again, you ask for all the respective documents supporting the new information. In terms of sanctions and embargoes, that is probably the second most important piece in terms of financial crime compliance. It's a bit more linked to terrorist financing rather than it is to money laundering. Sanctions and embargoes are imposed on other countries, usually by the authority of the United Nations. So mostly every single country on this planet is member of the United Nations. There is the Security Council, and the Security Council decides on sanctions imposed on various countries. Obviously, there are a group of countries or individual countries who can go beyond that and apply more sanctions or more intense sanctions. And then there are also countries you're dealing with who have so-called superpowers, and they can apply extraterritorial jurisdiction, most notably the United States. And I'm giving a bit more background to that, what it means. Sanctions and embargoes have a direct impact on the financial institutions. So what you have is the United Nations, they keep a record of every single person and of every single legal entity, so-called designated persons, who are restricted to have access to financial institutions because of usually bad behavior. Violations of sanctions on the side of financial institutions. So if you still allow these persons to operate in your company or through your company, have severe consequences and very high fines as a consequence. So it's really important that you have proper controls in place. What does it mean to have financial sanctions program in place? So once you have identified that a person potentially sits on a list by the United Nations or other bodies imposing these sanctions, you have to make sure that all the assets are being blocked and frozen, and that transactions are not going to be pushed through. Sanctions are in place usually to put pressure on other countries and certain individuals to refrain from bad behavior. Sanctions are quite low cost to impose, and usually can defer directly to the financial institutions to enforce them. And sanctions also are obviously a mean where you don't necessarily want to engage in military force to reach to a certain goal. I was mentioning that there are countries who apply extraterritorial jurisdiction. There are very few you will come across in the future. One is the US sanctions bloc. They have, because of the economical and military power, they can unilaterally impose sanctions, and non-compliance, even though it's not technically a law in your specific jurisdiction, can have an immediate impact on your financial institution because it will be barred from participating in international trading. And that is usually also the key focus point where you get involved. For example, if you tend to ignore US sanctions, they will bear you to work with US banks, they will bear you to trade in US dollars, they will bear you for financing US goods and services. And that's obviously the key angle here. The application of such extraterritorial sanctions are for people and entities who are either within the territory of the United States, US persons or entities who are outside the US, and then also subsections like where, for example, you're a company which is organized under US law. Usually it means that you have a US beneficial owner. For example, Paystack has its mother company in the US. So therefore we have to mandatorily apply US sanctions. You have employees of the US in your company who are required to adhere to these regulations, and other persons who basically or persons with a US connection who start infecting your overall business relationship. So in all these cases, so wherever you see like in any form, any connection to the United States, you will be required to comply with these regulations. Otherwise, you will not be participating in the international financial market. Also because other banks will stop working with you because they rather want to be part of the international market than working with you. So that's it's mostly peer pressure rather than immediate regulation in respective country. The next part is about monitoring and screening. I'm going to separate between screening and monitoring. Screening basically means you have a certain value. Either you have a name or you have a transaction coming through with information passed along that, and you have to match these names with various lists to make sure that they don't pop up anywhere. Monitoring is something else. That is where you focus your attention on the transaction itself and not on the person. I'm going to get a bit more into detail, but I just wanted to make sure that people understand the key difference between screening and monitoring. The KYC screening is thinking back of the due diligence process in the very beginning, in the onboarding process. So you sit on a set of names, either the name of the natural persons or the legal entities or the persons behind the legal entities. And all these persons must be matched against so-called PEP lists, where you can see whether this person is a politically exposed person or whether this person is affected by any sanction issued by a respective authority. You can also broaden your search, and you can also use and just see like, are there additional information on these persons, on these entities on record, which might have an adverse effect on your company. So for example, you might deal with persons where there's a known criminal history, or there is a known malpractice from a business in the background, which could threat the reputation of your own business, and you may want to be aware of. So this is what is called the KYC screening process. Very similar to the KYC process, you have the transaction screening process. There are various types of transactions. There are transactions where you have very limited amount of information passed along, like credit card information, where you can't really see who is the payer. You have very limited information on the credit card because of respective card rules. But there are, for example, regular bank transfers where you can see who is the sender, which bank account are they using. Sometimes they pass along ID information and date of birth. And once you have this type of information, again, you're obliged to screen all these names against the respective lists. The transaction monitoring is focusing on the customer profile. So in the onboarding process, once you have understood the purpose of the business and the expected amount of transactions coming through, the average ticket value the payer is going to pass through, and so on and so forth, you have a vague understanding of what an ideal transaction from that customer should look like. what you need to have in place is a monitoring program supported by IT, where you have measures in place to understand at the moment, is there an immediate risk coming from the transaction? For example, if your usual product is just worth $50 and somebody tries to transact $7,000, that should be flagged up immediately and stopped and investigated. There is also the long-term monitoring. The long-term monitoring is where not necessarily the first transaction is suspicious, but the second one or the third one, and all them combined start develop a suspicious transactional pattern, and you need to have systems in place to discover these. And the third bit, obviously, is the behavioral monitoring, is when you have the customer profile and just sees like all the transactions coming through. The values seem to be right, but for example, we see that a certain customer is only exclusively trading with 5 people, whereas there should be like 1,000 customers. So all these various aspects is something you should be aware of, something you should be able to flag and to investigate, and then obviously then put further actions in place. Before going to that, I'm going to have another quick break and give people in the audience time for some questions.
Okay, thank you so much for that, Michael. I am essentially going to join 2 questions, and it's around the regulations on money laundering. So firstly, have these regulations, which are around maybe know your customer, registering and ensuring the identity of the customer, have these regulations had an impact on the rate of money laundering in Nigeria, maybe?
So that is a very good question. I say it mostly depends on the business you're offering. For example, if you are a private bank where you have very wealthy customers, you will automatically have a higher risk of money laundering than, for example, a company like Paystack, which operates in online payment services where the usual transaction is rather low and doesn't pose a significant risk. There has been a massive impact, and it's not only Nigeria, it's actually around the globe. I want to say probably we have started seeing a massive impact around 2007, 2008, when around the globe has started strengthen the regulations and continuously doing so. And I'm going to come to that in my next slide, where I'm going to address suspicious activity reporting. The agencies dealing with these reports, they are usually providing annual reports, which should be publicly available. And you can actually see that every single year, more and more companies, more and more service providers in various areas, not necessarily only financial institutions, maybe also lawyers and notaries and other parties, started reporting an increasing number of suspicious transactions. So yes, there has definitely been an impact on that. Have we reached a desired level of effectiveness? My answer is probably no, because there is a trade-off here. Money laundering controls in the financial institutions are cumbersome and very expensive, and ideally you try to balance out the cost-benefit ratio here. So you want to contribute to the meaning of the regulation, but obviously you're not the police, so you're not going to overdo it as well. So that there's a certain trade-off here. But yes, in a nutshell, is yes, there has been a positive impact. Yes, there will be a positive impact, and yes, it is always going to become stricter. And this is also something I've seen in the past 12, 13 years now.
Okay, thank you. And just as a follow-up, you've somewhat answered it. Lawrence would like to know, why do we have KYC? Is it purely just to know the identity of the person or the entity that you're dealing with? And if you know the identity of your customer, does that show you where the funds are coming from, or does it go hand in hand? what exactly is the purpose of KYC, and is it effective?
That's a good question. So the key purpose is that you understand as much as possible about the purpose of the business relationship and the people you're dealing with. And the reason is, once you identify that there is something dodgy, something suspicious going on, you have to provide the authorities with a lot of details. And you have to provide, so the first, basically it's a twofold report. The first part is you provide substantial information on the customer structure. And the second part is you provide details on the transactional behavior. And the combination of the two of them will give the investigating authority, which is usually the police in the respective country, enough ground to continue the investigation you have already started doing in the financial institution. So basically, they just use you as a preliminary station to do the police work for them, and they rely on you that you have this information, because without that, they can't follow up on that, because they don't have the same access and the same overview on information you have in the financial institution.
Oh, okay. That's actually a good answer. Now I personally understand why the bank wants so much information from me.
Maybe I can also elaborate on that. Is there is no financial institution who enjoys pleasure doing that. So we do understand that this is quite a burden to the customer. And also speaking of, I'm trying to pull in the fintech aspect here. The companies these days who make the process, the KYC process, the least burdensome are usually the ones who are going to win the customer in the end. So if you are able to provide like a lot of technological support and automatize a lot of these collecting and monitoring and all that stuff, and to provide a good basis for cost saving and time saving and effort saving, these are the successful companies of the future. So this is where law and regulations tie in with technical innovation. And this is also what we do at Paystack. So when you sign up with Paystack, you will see that we have done a lot of effort recently to upgrade our process, to automatize checks in the background, to make the onboarding process at least the least burdensome, and to enable the customer to start transacting with Paystack as soon as possible.
Okay, that definitely helps a lot. Another question is, if you have to refresh your KYC annually, especially for high-risk customers, why is it that in Nigeria you're not allowed to bring in any documentation that is older than 3 months?
Because there's always a starting point, and you want to make sure that the documents you rely on are accurate and recent. If you work with documents which are a couple of years old, you have no evidence that the information given to you is actually accurate. Imagine that you set up a company 5 years ago with a certain ownership structure and a certain management structure, and you provided documents with that roughly around that date. Now, 5 years later, you go back to the customer and ask them, has anything changed? And they say no, where in fact actually it has changed. And the only thing they can provide to you is like 5-year-old documentation. If they provide you with recent documentation, which is only like 3 months old, we can actually verify if that information is still correct or not. Okay,
that's true, fair enough. And another question is, if you're collecting all of this information as maybe Paystack or a bank, is there any regard to data privacy laws?
Yes, and that is a very good question. So we take data protection very seriously, and we are obliged to take it seriously. So I'm thinking of Nigeria, but also like other jurisdictions. We have to comply with NDPR regulations. They are quite elaborate on how we can deal with personal data, and I think you guys are going to learn a lot more about that tomorrow. We have measures in place to restrict access to this information, and we also, and this is actually going to be the last part of my deck, where I'm going to say like how we deal with record keeping, and then so we have to balance between a regulatory requirement where we have to collect a lot of information and have to keep on holding this information to a certain point, and then also have to take into consideration data protection regulations, where at one point we have to let go of this information and to have deleted and destroyed them. So there's that trade-off there, yeah.
Okay, all right, perfect. This has to be a short answer because I see you're only left with 7 minutes for your presentation.
I think like it will take me like another 5 minutes, so we're good.
Oh, okay, and the questions keep coming in. How do you handle a customer who's unwilling to include his or her passport in the KYC process?
He will not be onboarded, end of story. If he shows malicious practice and malicious behavior, he even ends up facing the risk that's reporting to the authorities.
Okay, all right. So put in your passport details. Got it.
Mm-hmm.
All right. So do you want to finish? Then we'll take the last two questions.
Absolutely. All right. Okay. So imagine that with all the information you have collected, with the monitoring controls in place, you end up at the point where you feel like something is dodgy. What do you have to do? And that is called prepare a suspicious activity report, or a SAR. And that SAR is, as I mentioned before, where you provide to the financial intelligence unit, which is the technical term for the investigation unit following up on your SAR. That is usually police, but can also be like sitting in the Ministry of Finance or Ministry of Interior, depending on the jurisdictions you're operating in. They want to know why did you come up with a suspicion? Why do you think they are suspicious? And what is the predicate offense underlying, or which you suspect is being used or is being disguised for the money laundering process here? The SAR process in your company is a free-flow process. So you first of all is like you have a red flag popping up somewhere in your monitoring systems. You start investigating. You pass it on to your money laundering reporting officer in your company. Every single financial institution is required to have one. The money laundering reporting officer will determine whether there is an actual suspicious activity, and then will prepare a suspicious activity report, which goes to the financial intelligence unit for follow-up investigations. There's one very important thing you have to consider. Once you are dealing with suspicious activity, you're not allowed to inform the customer. So that is a very nasty process and very uncomfortable for you in the financial institution, because clearly you can't process the transaction of a customer, but you're also not allowed to tell him why there is no progress with his transaction, or why he can't access his funds and so on. So there's this is what the process looks like. Usually the financial intelligence unit, they have between 24 and 48 hours to come back to you and says like, yes, please block all the funds and we'll take over. Or they would just tell you like, no, you can continue operating with this customer. They don't concur with your assessment, and you can continue. The last bit, and we have also touched it a bit, is the record keeping. So all the information, all the documents you have collected on the customer and all on the transaction is something you have to keep record on for at least 5, sometimes even more, sometimes 10 or even longer years, either after the termination of the business relationship or after the execution of the transaction. Now, from a data protection perspective is, once that retention period has expired and there is no further obligation imposed to you by any regulatory authority, you then are required to let go of this data and delete it. There are certain circumstances, obviously, where you can hold on to the customer, for example, if the customer has given you express consent, but you still need to be in a position to delete all his data if he wishes to do so. And with that, I have reached the end of my presentation, and maybe we have time for 1 or 2 more questions.
Okay, we have 4 questions at the moment, so if you could try answer them very quickly. First question is, do you make use of information made public by persons or an entity, or do you source more information from various sources? So an example of this would be, for example, my bank collects information from other places, such as the clothing account company or another company that I would have registered information with. So is that how it's supposed to work or not?
So there are certain instances where you're allowed to rely on third parties. This is also where you can think of automatizing the process. So if somebody has verified information on record and it is a reliable source, you can basically try to verify against that information. For example, if there are databases in place, for example, if you want to look up in Nigeria, the registration number of a company, you can do this electronically, just going to the CSC register and just see like, okay, what is the number on records? And then you can do the check automatically if you have the respective means in place. There are certain information, especially when it comes to more difficult structures where you have customers where you don't have access to this third parties, or you have doubt that this certain source is a reliable source, then you have to dig in yourself and then you have to collect this data by yourself. It's very much depending on the risk and the acceptance, and also by the guidance of the local regulator. There are countries who are more progressive, they allow more reliance on databases, and there are countries, they're more insisting on a rather manual process where you have to collect physical documents or at least electronic copies of these.
Okay, all right. We are out of time, but are you willing to share your contact details so that whoever wants to follow up with any questions can do so?
Yes, I can do that in the end. I probably funneled that through the ICLA, and they can just they can pass me on a questionnaire, and then I will try to take some time to answer a couple of questions, which you then can share with people.
Okay, we'll do that. And thank you so much, Michael. One of the comments is that your session was interesting, but it was too brief. So hopefully we can get you back on to discuss fintech. But thank you so much for your time.
I know. It was a crash course, unfortunately. It takes obviously a lot more to implement a proper financial crime compliance program, but I just really wanted to give you a brief overview, and I hope I managed to do that. It was my absolute pleasure, everyone. Have a great day.
Thank you so much.